Hi, this is a presentation from the Duke Financial Economics Center on Investment Banking 101. I'm Chris Wade. This presentation is meant to cover what is investment banking. So first, we'll start off with an introduction to corporate finance, which is effectively the field of how companies raise and use capital to fund their operations. So on the left here, you see the two sources of capital for companies, debt and equity. Debt is when companies borrow money from investors that they need to pay back on certain terms and with interest. Equity is when companies sell a stake in the company to investors that do not have set repayment terms, but that investors invest with the hopes that the company will grow and thus will grow their share in the business. Companies raise this capital so that they can do three things primarily. First is to fund their ongoing operations. So sometimes companies have seasonal businesses where they may need capital at certain times of the year, or they may be hiring new people and may need more capital than the profits of their business support. So many times companies will go out and raise money simply to fund operations. Second, companies will raise capital to fund investment in growth. This can include building a new manufacturing facility or building a new product. Anything that a company has identified as a strategic objective, they may go out and raise capital for in hopes of growing their business. And the third main bucket for which a company will raise capital are acquisitions. So this is when a company wants to go out and buy another company, either to buy a new product, buy a new service offering, enter a new geographic area, or even buy out a competitor that they think is threatening. In all of these cases, companies have needs to raise capital for what they are trying to achieve. So, where does investment banking come in? So, what companies are built to do is deploy their resources to operate the business and grow. And as part of that, they are also the stewards for steering capital towards investment in growth. But most companies are not built as a core competency of raising capital, of raising debt, equity, or pursuing acquisitions. So that's where investment banks come in. Companies will go out and hire investment banks, which manage a lot of those capital functions for companies for a living. So the functions that are circled in blue and that show blue arrows are functions that an investment bank will typically do, that a company will hire an investment bank to do on behalf of the company. And the orange arrows show where the companies conduct their operations. So on the left, you see debt and equity coming in with blue arrows. So those are two core functions of investment banks, going out and raising debt and equity capital for companies. And then on the right, you see a blue arrow pointing towards acquisitions. So when a company wants to go acquire another company or sell itself, it will hire an investment bank to run the sale process or advise the company as it is buying another company. So those functions are blue, or what are typically called in investment banking as deals. So a deal is a transaction where a company is either raising capital, debt or equity, or buying another company or selling itself. All of those are transactions involving a company and some third party or a mix of third parties. For example, when raising debt or equity, companies are receiving money that is invested by investors, which they receive in that capital raising transaction. In an acquisition, it is when they go out and buy another company or sell themselves. So these are the transactions that investment bankers will refer to as deals. So what are some examples of what these deals look like? So again, there's a couple main functions of why companies will raise capital. The first example here is when a company wants to raise debt or equity capital to fund its business operations and growth. So in this example, so let's say a company wants to build a new manufacturing plant, but they don't have the money to do so. They can hire an investment bank to go out and raise either debt or equity capital and then go spend that money to build their new manufacturing plant. They will then use the profits from that manufacturing plant to pay off the debt capital that they've borrowed and to return profits to the investors that invested equity to own a piece of the business. What's that look like in the real world? One name that you see in the newspapers a lot is Tesla. They are growing rapidly and they are raising a lot of capital to do so. Depending on the year, they may be raising debt or equity since they are using both sources of capital to fund their growth. They are spending a lot of money, billions of dollars at a time, to build new factories as they expand and produce rapidly increasing numbers of new cars every year. And when they're also building a new factory to build the batteries for all these cars. So you will often see them in the newspaper with headlines of how they are raising debt or equity capital to fund their growth. So what's an example of an acquisition? Where would an investment bank come in to help a company, or why would a company want to do an acquisition? So a common example here is a company has built up over time and offers a set amount of products, and some startup invents a new product that the original company, the bigger established company, doesn't have. They will often go out and try to acquire those companies to expand their product lines in segments that they think are growing. So in this example, this is when a big company that is very profitable, has lots of cash on hand, is able to go use the cash that they've earned in profits and acquire smaller businesses. An example of that in the real world is last year, Apple acquired Shazam for $400 million. So to be clear, $400 million is not a small deal by any means, but when you compare it to how big Apple is, you see that this was an easy deal for them from a financial perspective. So Apple's a big public company, one of the most profitable companies ever. They have a market cap of around $800 billion. And at the time of this acquisition, they had about $20 billion in cash on hand. They acquired Shazam for $400 million. So that was less than 2% of the cash that they had in the bank. So not too hard to imagine that this was easy for them to write that check. They had the cash. They went out, hired an investment bank, did their due diligence to figure out what Shazam was worth, and then they wrote a check to buy the company out of their bank account, essentially. So again, an investment bank here would have represented Apple as they looked at Shazam, researched the financial statements of Shazam, determined how much it was worth, and then there would have been another investment banker on the other side of the table representing Shazam, helping them through the sale process, maybe negotiating with other buyers that may have approached Shazam as well, and negotiating for as high of a purchase price to the Shazam shareholders as possible. So also in the acquisition category, oftentimes these acquisitions are very large and are big enough to the point where a company cannot afford the acquisition with the cash that they have on hand. So what you will often see is companies go out and agree to acquire a company that is very big, oftentimes as big as they are, sometimes even bigger. And what they will do is they will go out and raise debt and equity capital alongside this acquisition. So they will use the value of the company they are acquiring to justify the debt and equity capital that they are issuing in the marketplace, raise a flood of new capital to come in and fund the acquisition that they are pursuing. An example of this was the deal AT&T reached to acquire Time Warner. So this was a massive deal. AT&T, a big telecom company, was agreed to buy Time Warner, a big entertainment company, for $85 billion. And very big deal. So again, whereas in the Apple buying Shazam example, Apple had more than 15 times as much cash, or sorry, needed only 2% of their cash on hand to acquire Shazam. In this case, AT&T has $5 billion in cash on hand, and the Time Warner acquisition was for 15 times that amount, for $85 billion. So that means AT&T needs to go out and raise a lot of money to fund that acquisition. And as you see in the headline, that's exactly what they did. So half stock here means that AT&T is issuing equity to the shareholders of Time Warner for that half of the deal, and half cash typically means that they are going out and raising debt capital as well. So AT&T will go out and issue $40-ish billion of debt, which they will then turn around and give to the shareholders of Time Warner to fund the acquisition. So from an investment banking perspective, you can imagine this is a large and very complicated deal, given that it involves raising debt capital, equity capital, as well as negotiating with Time Warner and agreeing to them on a valuation for how much that company is worth and what mix of cash and stock that they will receive in the deal. So you can bet that there were a lot of investment bankers working very hard on all sides of this. And again, recall, AT&T will have hired an investment bank to help them figure out the terms of raising that debt and equity capital, as well as helping them on their due diligence, researching Time Warner and coming to a valuation that they thought was fair to pay Time Warner. And then Time Warner will have hired investment bankers as well to advise them on the sale process, make sure that they are getting a fair price, and negotiating on their behalf. So one last note, those are the major categories of deals you will see within investment banking. If you are meeting with people in investment banks, though you'll hear a number of terms, the topics I just covered are primarily what will fall in the investment banking division within banks. So these are the groups that do mergers and acquisitions, as we just discussed, and that will help companies raise debt and equity capital. You will also hear the term sales and trading. And what that is, that's a separate part of the bank. These are groups of people that buy and sell debt and equity securities that have already been issued by companies. And they're typically doing this sales and trading on behalf of clients that are investing in these securities. And I've got a red divider here. One thing to be aware of, these two groups are typically restricted from talking to each other. For example, if you are working on a big merger in investment banking, on the investment banking side of the house, that's typically very private information and would impact their stock price or the value of their public securities. So that information is not meant to be shared with people that are selling and trading their public securities. So that's just one final note on how investment banks are typically divided. So hope that was helpful, and good luck in recruitment and in figuring everything out going forward. Thanks. Goodbye.